everyone, this is Cody with Rent Reporters, and these are the 6 things that hurt your credit score. Now before we dive in, don't forget to like and subscribe to our channel for more content like this every week. So number 1, a lack of credit history. Now this is the classic credit score catch-22. You build credit with credit cards and loans, but you need to have a credit score to get approved for a credit card or a loan. No or low credit history means a low credit score. But did you know that lenders don't look at just your credit score? They'll also look at your entire credit report, which is far more detailed than just your score. You can use Rent Reporters to report your rent payments to credit bureaus to build both your credit history and credit score, as well as use products like Experian Boost, which add your subscriptions, utilities, and cell phone bills to your credit history, both of which are great ways to not just build your credit history, but give you a big boost to your score. Number 2, you have an error in your credit report. An FTC study found that 25% of consumers had an error in their credit report from one or multiple credit reporting agencies. Now, errors can be caused by simple human mistakes, or they can be caused from things like fraud, which is when someone gets a hold of your information, opens up a credit card or loan in your name, spends the money, and then doesn't repay the debt. And this shows up on your credit report as a delinquent account and really hurts your credit score. It's a good idea to keep a close eye on your credit report and look out for anything at all that you don't recognize, like unexpected charges on your cards or new accounts that you did not open. If you find something, be sure to contact the company on the credit report and let them know that you don't recognize the account or charge, and then contact the credit bureaus to let them know there is a mistake and potential fraud on your account. It's also not a bad idea to freeze your credit. Number 3, you made a late payment. Now this one should go without saying. On-time payments are the most important factor in your credit score. Just a single late payment can significantly ding your score. So always be sure to make your payments on time, and the easiest way to do this is to use automatic payments on your bills and credit cards, and always pay at least the minimum payment on your credit card by the due date. Even better is to pay off the statement balance in full by the due date so that you don't get charged interest. Next up at number 4, you've applied for too many credit cards and loans in a short period of time. Every time you apply for credit, a hard inquiry appears on your report. Now, these typically only affect your credit score by a couple of points, and then their impact will fade away after a couple of months and your score goes back up. However, while the impact on your score might only last a couple of months, the inquiry itself remains on your report for up to 2 years. Now, having too many hard inquiries on your credit report in a short period of time makes the credit agencies wonder why you need to open so many new accounts, which means that you look risky in their eyes, which hurts your credit score. So be sure to only apply for credit when you really need it. Number 5, you closed an account. If you pay off a card and close it, you'll end up hurting your score in a few ways, and it can be significant. First off, that account no longer counts towards your average credit age. Let's say you have 2 cards total. One is 10 years old and the other you just got brand new. Well then, your average age is 5 years. It's the total credit age divided by the number of accounts. Well, if you close your 10-year-old account, now your average credit age is less than a month. So next, your total available credit decreases, which affects your debt to credit ratio. Now, using the same example, let's say that the 10-year-old card has a $5,000 limit and your new card has a $3,000 limit. Your total available credit is $8,000. Now, let's say you typically have a $1,000 balance. That works out to a 12.5% debt to credit ratio, which is good. Lenders like to see that you're not maxing out your credit, so staying under 30% is considered a good ratio. But when you cancel your old card, now your total credit is only $3,000. That very same $1,000 balance is now 33% of your total credit, and now your ratio looks a little high and your score will drop. And finally, at number 6, you opened a new account. Now wait a minute, your score goes down when you close an account and when you open one? Well, yes, but opening an account is usually a smaller dip that recovers quickly. Now, when you open an account, your score drops because of the hard inquiry we talked about earlier, and because it's brand new, which lowers your average credit age like we just talked about. On the other hand, your total credit goes up, which will positively affect your debt to credit ratio, which is why the dip on your score is typically smaller. Now, as time goes on, the account becomes more mature and you continue to make on-time payments while your score goes right back up. And there you have it. There are 6 things that hurt your credit score. Now, hopefully you have a better understanding of what affects your score and are better prepared to manage your credit. Once you manage your credit score, you can really begin to make the system work for you and take advantage of rewards cards that offer valuable cash back and perks, along with saving hundreds, even thousands of dollars on car, home, or personal loans, even on insurance products, and you can even boost your chances of getting hired. Your credit score matters, so make sure you take care of it. Again, don't forget to like and subscribe to the channel, and until next time, this is Cody with Rent Reporters, and I will see you in our next video.